Hello, this is Gavin Martin here from Cornerstone Wealth. Welcome to the Christian Super Retirement or Transition to Retirement webinar. Thanks very much for joining us. I have Phil Watson, the Digital Marketing Coordinator from Christian Super here to intro the session. Thanks, Phil, so much for being online.
No worries, mate. Nice to see your smiling face once again. And I think this is the first time in quite a while that I've been on a webinar, so it's great to be back.
Yeah, thanks so much, and particularly on a Monday evening when you could be watching, Four Corners or something it might be.
Exactly. What's that? Is that on Netflix?
It's an ABC program.
My parents' TV channel never moves us ABC, so every time there's a new show on, I'm like, hey, Mum, you should watch this. And don't worry, it's not on ABC. You won't get to see it. So nothing wrong with the old ABC. So, yeah. And welcome to any participants we have. It's great to have you guys along and, for this transition to retirement webinar.
Just a quick disclaimer that tonight's advice is advice of a general nature only. Please seek your own personal financial advice before making any decision. If you are seeking, we would like us to help you with seeking financial or personal financial advice. The way we do that is have you complete a questionnaire, meet with you for an initial consultation where we try to understand your goals more fully, look at your current situation, and then talk through the pros and cons of the range of options for you. If it's warranted, we can present some recommendations to you in writing, help you implement it and provide ongoing advice. So you can take that process as far as you need to or get value from. So tonight we're talking about transitioning to retirement, and specifically we're talking about salary sacrifice or personal deductible contributions, transitioning or the transition to retirement strategy. And the important parts about that is that when you can access your superannuation and how you can access your super, and then a little bit about tax as well. So we're getting into the mainly strategy stuff tonight. We talked a little bit more about the soft issues of retirement and how much you might need to retire in the previous webinar. And that's available online at cornerstonewealth.com.au/retire 2019, where all the series will be available. So if you want to catch any of the webinars, just go to that website and you'll be able to find them. So just to get stuck right into it, salary sacrificing is by far one of the best strategies to boost your retirement savings. It saves tax and boosts your super. So it's an important part of most strategies that we implement. So to understand it is really valuable, and if you can implement it and get some value from it, it's a great win. So this is what happens normally when you're not salary sacrificing. So your employer will deduct some PAYG tax, your withholding tax from your income before you get your money into your bank account from your pay. And the tax rate depends on how much you're earning. So if you're earning between $20,000 and $37,000, the tax rate's 21%, including Medicare levy, or $37,000 to $90,000 of annual income, it's 34.5%. Over 90 to 180 is 39%, and then over $180,000 is 47% tax rate. So that's your standard rates that your employer will deduct your tax from your pay before paying the remainder into your bank account. And then from there, it's in your bank account. You can spend it, you can put into super or save it or give it. You can do what you want with it at that point. So that's how that's not salary sacrificing. The way salary sacrifice works is that prior to the employer calculating how much tax is paid, they put money into superannuation prior to the tax calculation. So when it goes into super, there's some tax paid on the contributions, but the tax paid is actually 15%, or if you earn over $250,000, 30%, versus what you would pay at your other marginal tax rate. So your employer puts the money into super, it reduces your overall income, and then they'll deduct less tax, less withholding tax, and then the remainder will go into your bank account. You're always going to get less than if you didn't salary sacrifice, but it's not to the same tune as the amount that you're actually directing into super, because there is a tax saving there. So once your employers put a little bit less than the no salary sacrifice arrangements into your bank account, you can then spend it, save it, give it, etc. But the key to understand is that the difference between your contributions tax rate of 15% or 30% if you're earning over 250 grand is your benefit. So if you're on the 21% tax rate, the benefit of salary sacrifice is 6% of whatever you're salary sacrificing. If you're on the 34.5% tax rate, the difference between that and 15% is the 19.5%, so nearly 20% benefit. And then if you are on a 39% tax bracket, then the benefit is 24%. And if you're on the 47% tax rate, then the benefit's either 32% if you're earning under 250,000, or it's 17% if you're earning over 250,000. Labor's policy going into the election is that they want to reduce this threshold to 200,000. So if you're earning over 200,000, you'll pay contributions tax rate of 30%. So that's the difference. The key difference in salary sacrificing is that your employer is directing some money to your super prior to withholding some tax. And the net benefit is that the difference between the contributions tax rate and your marginal tax rate up here. That's how salary sacrifice works. But previously, those people who were self-employed were able to or substantially self-employed, that was no more than 10% of the income was coming from employment purposes, they could make what we call personal deductible contributions. But from 1st of July 2017, the government has allowed anybody to make personal deductible contributions, and they have exactly the same outcome as salary sacrifice, but it enables a lot more flexibility. So with salary sacrifice, you've got to do it, plan it ahead. It's only future income that you can direct into your super account. Whereas with personal deductible contributions, you can wait just before the end of the financial year, put a chunk of money into super, and then claim a deduction on that. And it achieves exactly the same outcome as salary sacrificing. But it's just a different mechanism for doing it, and it enables a fair bit of flexibility. There is a different process by which you need to set it up. So with salary sacrifice, you're setting it up with your employer. Most employers allow you to do that, but sometimes it can be difficult to work with the employer, so that's where personal deductible contributions come into play. Again, Labor have flagged pulling that back again, personal deductible contributions, but they haven't been 100% clear on how they're going to adjust it. But hopefully they don't adjust it significantly and therefore make it difficult for people to take advantage of this strategy. So if you go salary sacrifice track, you just deal directly with your employer and ask them to direct your part of your pay to your super. If you're going down the personal deductible contributions, the way that you do it is you make a super contribution to you do it personally from your own bank account to your super account before the 30th of June each year. After the end of the financial year, you can actually calculate what the optimal amount to claim as a deduction. Say, for example, you put in $20,000 here. Once you're in the new financial year, you can submit, or you need to submit, an intent to claim a deduction form. It's an ATO form, but you submit it to your super fund. So of the $20,000 that you put in, you need to specify how much of it you'll claim as a deduction. That will then trigger a 15% contributions tax on that deduction being charged, but it will enable you to reduce your taxable income by the amount of the deduction. So steps in the process: make the contribution, submit the intent to claim a deduction form to your super fund. They'll then confirm that you've received the deduction, or they've processed the deduction. Contributions tax is paid at 15%, and then you can submit your tax return. Don't submit your tax return before you have received the confirmation from the super fund, because the government doesn't allow you to resubmit your tax return if you haven't already processed the claim. It can be a bit of a catch, but it does provide flexibility, just a very different mechanism for achieving the same outcome. And similarly, once you've put the money in prior to the end of the financial year, Don't make any rollovers or withdrawals or submit your tax return before completing the deduction. Otherwise, it can mean that you can't claim the deduction. Really important too. So a few more traps for under the deductible contribution mechanism, but it is a lot more flexible as well. Enables financial advisors in particular to be able to really specifically claim the exact right amount. So what's the benefit of salary sacrifice? And when I mention salary sacrifice, you always interpret that as also a personal deductible contribution. They're interchangeable from this point forward. So the benefit is that the employer is deducting money to your super account rather than your bank account. It means that you save tax and you're actually saving, building up your retirement savings. The actual calculation to work out the benefit or how much benefit you're going to achieve is your marginal tax rate plus the Medicare levy less the 15% contributions tax rate, or if you're earning over 250,000, 30% contributions tax rate, and then multiplied by the salary sacrifice amount. So an example is Ben's 60 years of age, he earns 70,000 a year, his salary sacrifice is 10 grand, so his marginal tax rate's 32.5 plus 2% Medicare levy, less 15% means that it's 19.5% benefit multiplied by the 10 grand. So annually, Ben could achieve nearly a $2,000 benefit by salary sacrificing $10,000. It would actually increase a little bit more than that because there is a low income tax offset and SAPTO, Senior Australian, and well, not for Ben, but others who are pension age, could also be receiving some additional benefit by salary sacrificing as well. But that's the minimum benefit for somebody on 70 grand would be the $1,950. So well worthwhile. You could do that year on year. If you're 15 years out from retirement, you could be saving 30 grand in tax that's going to be in your pocket rather than sending it to the government if you can do that for the 15-year period. Now, the question is when you should salary sacrifice, and it's not always an automatic thing that you would salary sacrifice. So the things to consider for your particular scenario is, do you have debt? So if you've got consumer debt, so that's credit cards, credit card debt ongoing, not debt that you pay off each month, but you've got an ongoing debt, or if you've got mortgage debt or car loans, etc. Generally, you would focus on those first, but there is a time at which we do weigh up the difference between focusing on the mortgage versus salary sacrificing. So you might not have paid off your mortgage fully, but as you're approaching the age at which you can access your super fund, we sort of think, well, you're going to be able to access the money in your super relatively soon. So let's not worry about paying off the mortgage fully at the moment. We can save multiple thousands in tax, and in a few years' time, we'll access that money. You can pay off the mortgage with that amount. So you don't have to have fully paid off your mortgage, but the closer you are to being able to access your super money, the better it is. If you're in your early 20s and you're really focusing on saving for a house, it is nice to salary sacrifice, but it's probably not the priority. So you'd probably think about saving a deposit for your home as opposed to salary sacrificing. Your tax rate's important. If you're earning less than $20,500, your tax rate's 0, and there's no point salary sacrificing, so don't bother there. You've got to be under the contribution limit. So the concessional contribution limit this financial year is $25,000, so you can't salary sacrifice more than that. And you also need to factor in your superannuation guarantee contributions. The 9.5% that your employer puts in is included within that 25,000 contribution limit. And cash flow, you've got to have the money to be able to do it. You can't salary sacrifice to super if you're not going to be able to pay your mortgage, for example, or your rent or whatever it is. So you've got to have the cash flow to afford to do it. Sometimes the transition to retirement strategy can help with that, and we'll talk about that more. And then access to your super. So when you can access your super money and when you will need the money is another factor. So often if people are thinking about educating kids and it's going to be private schooling and it's costly, you might not salary sacrifice prior to that. You might hold back some funds, sacrifice paying a bit more tax just to have the money available to you outside of super. So I'll talk through that in a little bit more detail. But the important thing is, when can you access your super? The age at which your super becomes accessible to you is your preservation age, which is based on your date of birth. So it was previously 55, but now I think we're getting up to 57. I think for most people, preservation age would be. And then once you're born later than the 30th of June 1964, then your preservation age is 60. That's the age at which you can access your super money. So that's the age at which you can access your super, and depending on whether you've satisfied a condition of release or not determines how you can access it and what sort of access you have. And a condition of release is one of three things. It is if you are under 60 years of age, it's ceasing gainful employment, and you also have to state that you're not going to become gainfully employed again. So you've reached your preservation age, so you might be 57, you've stopped gainful employment, so you've ceased work, and that you have to declare that you're not going to return to employment, and then that satisfies a condition of release. You've got full access to your super money. There are some tax ramifications if you do withdraw it all, so just consider that first, but you do have full access to your money if you're under 60, but you've reached your preservation age and satisfied those two criteria. The other condition of release is if you've reached 60 years of age and you've ceased gainful employment. Once you've reached 60, there's no need to say that you don't intend to return to the workforce. You can actually have two jobs, cease one, and that'll satisfy a condition of release. Now, this is really helpful when we're trying to implement the best tax-effective strategies for people. So that is something that has come into focus a little bit more in the last couple of years. If you can satisfy that condition, it's really helpful. And then the catch-all for a condition of release is when you turn 65, you get full access to your super money at that point in time. The other question is how you can access your super money. So you can access it in the form of a lump sum if you've reached a preservation age and you've satisfied a condition of release. And then you can only access it in the form of a pension if you've reached a preservation age but not satisfied a condition of release, and the maximum that you can withdraw is 10% per annum, and that's called a non-commutable account-based pension. And if you're under 60, there's a tax-free threshold, so that was the tax I was talking about. You can draw it up to $205,000 from the super account of what we call taxable components and pay no tax on the withdrawal. Once you turn 60, withdrawals from superannuation are generally tax-free. But if you've met your preservation age and the condition of release, then you can start what we call an account-based pension. And the key thing there is that the earnings within the account are tax-free. And this is a change a couple of years ago. These accounts, non-commutable account-based pensions, used to be tax-free earnings as well, but they changed the rules 2 years ago. And these are the minimum amounts that you need to withdraw based on your age from your superannuation. Just got David asking, you mentioned that there might be a situation when not paying off the mortgage rather than salary sacrifice would be better. Might there be a situation when a slight increase in loan to borrow the money to make the personal deduction, currently 59 years of age and not working and not intending to? So if you're not working and you're not intending to, then you've got full access to your super money. So there's, but if you're not working, it depends on if you've got a taxable income. So if you're not paying tax, then there's no point making deductible contributions into super. If you are paying tax, then you should be able to access your super money and then put it back in again under that scenario. Thanks for the question, David. Keep them coming through if anyone's got questions. So how much should you salary sacrifice? And this might relate to you, David. You ideally would not pay tax at more than 15% because that's a contributions tax rate. So in terms of the tax-free threshold, it's $18,200. So you don't pay any tax if your income is less than that. But there's what we call a low income tax offset, which means that the effective tax-free threshold is 20,500. So if you're earning less than 20,500, then there's no point salary sacrificing. You're just going to pay more tax than you need to. But once you're earning more than 20,500, that's when you start to get some benefit, because that's where there's the difference between these figures and 15% is your net benefit. So here's an example. We've got someone on $40,000 of income, and they're going to salary sacrifice 19,500 and get their taxable income down to this $20,500 threshold. They'll pay no income tax, and they'll save in the process about $1,200 in tax, in income tax. That's after factoring in their contributions tax. So a good way to save a little bit of money, even on a on that $40,000 taxable income. Ken's just asking, is it worthwhile putting personal deductible contributions into a first home savers super scheme? Does amount need to be withdrawn before Labor wins the election? Yeah, it's a really good question. Unless you were going to use the money either this financial year or maybe early in the new financial year, I wouldn't be too keen on it. You can save around sort of $4,000 to $6,000 in a very short time frame by putting 15 grand into the super fund and then withdraw it using the first home saver super scheme. But the fact that Labor has announced that they're going to abolish the scheme, it just presents risk that you might just have contributed that money to your super fund and not be able to get it out for your first home. So I tend to think that the risks of not being able to access the money are a little bit too high at the moment in terms of using that scheme. Thanks for the question, Ken. Yeah, you don't want to salary sacrifice if you're not paying any tax, but bring your taxable income down to 20,500 is good. The other thing in terms of how much you should salary sacrifice is you don't exceed the concessional contribution limit, which is $25,000 per annum. But it does include your super guarantee, the 9.5% your employer puts in, any salary sacrifice and any personal deductible contributions. So the total of those types of contributions cannot exceed $25,000 per annum, so per financial year. So if we've got someone on $115,000, for example, they might think, well, the limit is $25,000, so therefore I can put 25 or salary sacrifice 25,000 in super. But unfortunately, they haven't factored in their superannuation guarantee, so they would exceed their contribution limit, and they would need to pay some of that excess contribution at their marginal tax rate and a small interest penalty as well. It's not a massive penalty, but you don't really aim to breach it. You might breach it incidentally, but you don't aim to breach it by $10,000. Intentionally. You wouldn't do that. It just doesn't make sense. So what you could do is, in this scenario, if you're on $115,000, your employer is putting in just over just under $9,000 into the super, and so you can put in the $14,075 into salary sacrifice, and so that's the optimal figure there. So the difference between your it's a bit over $10,000. Sorry, $10,925 is what your employer is putting in. So you can put in $14,075, which will save net tax of $3.5 grand. Now that's $3.5 grand tax or annually. So if you count that year on year, as I mentioned before, that's like over 10 years. That's $35,000. If you compound those, the earnings on that as well, it'd be well over $40,000 of benefits over that 10-year period. So a really valuable strategy to boost your retirement savings. So that's the sort of optimal at that figure. Now, how much should I salary sacrifice? Factoring in cash flow requirements. So if you're on $115,000, it might be nice to salary sacrifice the maximum $14,000, but if that means that you've got an income shortfall, as in you haven't got enough money to pay the mortgage or rent or other expenses, then it doesn't make sense. You might need to scale it back. So you could scale it back to what you could afford cash flow wise, and that might be $5,000 that you could salary sacrifice, but you would miss out on the savings of around that $2,314 in this scenario. And this is where the final strategy comes in, where if you don't want to miss out on the savings, you've potentially reached your preservation age, you can salary sacrifice the maximum and then use some of your super money in the form of a pension potentially to make up the difference in income. So you're maximising your savings, you're getting the $3,500 to $600,000 in tax benefit, and you're substituting income with other superannuation income. And that's the transition to retirement strategy that we'll talk through now. So what is the transition to retirement strategy? It was originally introduced around in 2006-07 when Howard and Costello introduced the simpler super changes. And the whole purpose of it was to enable people to access their superannuation without retiring. They were losing so many quality workers because they had to retire to access their super. And so they're retiring and not going back to the workforce. And so they loosened the rules up so that you could access some of your superannuation money to substitute your income as you move from full-time to part-time work. It did that effectively, but what was probably more effective was the strategy where you kept on working but moved your money to pension phase and save tax by drawing from your super and salary sacrificing at the same time. The thresholds then were 50 grand a year, not 25,000. So it was a really effective strategy from 2007 till about 2017 when they pulled the strategy back and started taxing, or reduced the thresholds and started taxing transition to retirement pensions. But there are three main benefits. The first one is salary sacrificing, which is what we've just talked about. And the other one is that you can get a tax-free income if you're 60 years of age. And it could be concessionally taxed if you're between 55 and 59 years of age. Now, there are not that many scenarios where we move to a transition to retirement pension when you're under 60 years of age. So between 55 and 59 years of age, often we're holding off starting a transition to retirement pension. We used to do it because there were other tax benefits. There was no reason to not do it. But currently, from the last couple of years, if you're between 55 and 59, we haven't generally, unless you've got unique circumstances where you've got no taxable income, we haven't been focusing on that particular strategy, that part of it. But once you turn 60, all drawing from your superannuation is tax-free. So then it becomes a lot more useful at that point in time. So three benefits are salary sacrifice, tax-free income when you're over 60, or concessionally when you're under 60. And then the third one is there's a 0% tax rate in the pension phase if you've satisfied a condition of release versus 15% in the accumulation phase. So on a $500,000 super balance that was earning 5% or $25,000 per annum, that's a tax saving annually within the fund of about $3,750. And it's well worthwhile doing. But now you've got to satisfy that condition of release that we talked about earlier to access that. And if a condition of release isn't met, you can still access up to 10% of the balance. So if you've got 500,000 in super, you're over 60, you haven't satisfied a condition of release, but you can still move to the pension phase and draw $50,000 tax-free income and make up that income gap if you're salary sacrificing. So it does work well. The strategy isn't as effective as it was a couple of years ago, but it's still very useful to boost your retirement savings, save tax. So here's an example of how it works. We've got an accumulation balance. So this is just your standard super fund that you're putting money into. It's got a balance of $200,000. We simply leave the minimum balance in that of $5,000 and we roll over the rest of it to pension phase. So now we've got two accounts. We've got the accumulation account, which we continue to add to. So we continue to put if you're eligible for the government co-contribution, you might put $1,000 in it to get the $500 co-contribution from the government. You've got your employer contributions going into that of 9.5% of your income, and you might make salary sacrifice or personal deductible contributions into that as well. So you're still building up this account over here. It's good to leave it open, particularly if you want to retain insurances within that account and you're working and need to make further contributions. And over here with this pension account, there's two reasons that we might start it. One is to access the payments from it, so up to 10% of the balance if you're in a transition to retirement, so you haven't satisfied a condition of release, so you need to draw between up to 10% of the balance, so 20 or 19,500 could be drawn from here. If you're over 60, that would be drawn from the pension account into your bank and be tax-free. And then you could use that then to potentially enable you to make your salary sacrifice contributions, or use that money to pay for your everyday expenses so that you can sacrifice some of your income into your super account. So that money from your superannuation pension can go back into your other account, or you could use it to live on if you're salary sacrificing to income. So that's effectively how it works. They're still invested, the funds are still invested. There's the same options within each accumulation account and a pension account. So you'll get the investment growth on them depending on which investment option you're in. The other benefit, as I mentioned, is that if you have satisfied a condition of release or you've turned 60, the earnings, this investment growth can be tax-free earnings, whereas this investment growth over here is at 15% always. So that's practically how it works. Now, I had a couple of questions. This one was from Gordon, who asked about the fact that him and his wife are 70 years of age and they're planning to retire, but they've both got super accounts, and saying, well, can we combine them into one account rather than having two separate accounts? The benefit of that would be just the administration fee, $1.60 a week with Christian Super, or $83.20 per annum. So by combining accounts, if you could combine accounts, then you might save that $83.20 a year. You can't sort of just combine accounts, like merge them into one. You can possibly withdraw the funds from one person's superannuation account into your bank account and then put it into the others, but you just got to be aware of the contribution limits. So there's a non-concessional contribution limit of $100,000 per annum this financial year. Labor's proposing to reduce that to $75,000 per annum, and there's a $25,000 concessional contribution limit. This is the non-concessional contribution limit. The $25,000 contribution limit is the concessional contribution limit. And the other thing is, if you're over 65, you've got to satisfy the work test. So you've got to be working at least 40 hours in 30 days once during the financial year to make contributions to super as well. So you could merge them, but it's not a simple merge. It's a withdraw the funds, and under the contribution limits, put the money back into the other spouse's account. So thanks for the question there, Gordon. And then the other question was from Michelle, I think it was, and she was asking around the transition to retirement withdrawals. And she's saying, once you've reached the preservation age, I believe you can draw 10% of the balance, which you can. She's asking, is it calendar year or financial year? How does it work? How it works is that if you haven't met a condition of release, you're under what they call we call it either a transition to retirement pension or a non-commutable account-based pension. And that means you can draw 10% from that account once per financial year. But if you do what you call rebooting that account, so if you merge that account with another super fund and restart a new pension, then you can draw another 10%. So sometimes what happens is we draw 10% early on in the financial year from a transition to retirement pension. We then make a contribution to the super account, and then we merge that amount with the existing pension and create a new pension, and we draw another 10%. So you can do more than one lot of 10% per annum. And in terms of timing, generally there's, I think, a 30-day service standard to create an account, and then depending on when that falls, as in pension payments are only generally done in the 15th of the 28th, I think, of the month. It's generally normally the 15th. So depending on when the account's open, it could be 45 days for that to happen. Hopefully that answers your question there, Michelle. So that's the key strategy. Well worth understanding, particularly if you're moving towards retirement. They can save multiple thousands of dollars, those strategies, annually. So if you can understand them, they're well worthwhile implementing. If you want further information, as I mentioned at the start of the session, the recording of this will be available at cornerstonewealth.com.au/retire 2019, and you can register for the next 3 webinars. The next one on the 1st of April, and it's not a joke. On the 1st of April, it's the reduced capital gains tax and maximise your estate. So that's just some specific strategies. One, the maximising your estate is about cashing out your super contributions. So Gordon might find it useful. Cashing out your super and then recontributing it saves death benefits tax. And then if you're selling an asset, then reducing capital gains tax as well we'll address that in the next session. And then the 2 after that are really about Centrelink. So the basics of Centrelink in a fair bit of detail, and then we talk about some specific strategies that we find are useful in the final webinar regarding Centrelink and the age pension. If you want personal advice, then feel free to contact us either via the website or via phone. And then Christian Super's help desk number you're probably all aware of, and the website. And there's also some online calculators and tools. If you log into your member login, and there's a thing called Super Equip or Equip Super. Can't remember which way it is. But that's got some calculators if you're wanting to run some numbers yourself as well. So that's the main content for this evening. The recording will be available, and feel free to ask questions now, and I'll address them until we run out of questions. I just got one from David. Actually, no, it's Kathy first. He said, I have just returned back to work part-time after 6 months, and I'm 64 and a half years of age. Are you able to take any of your super out before 65 if I'm not salary sacrifice? They're 2 separate issues. You don't have to. You can. Drawing money from your super and salary sacrificing are 2 different decisions. If you're not 65 yet, so you're 64 and a half. And you haven't satisfied a condition of relief in the past, then probably the best way to be able to access your superannuation money would be moving to a transition to retirement pension, that strategy where you leave a little bit of money in your accumulation account and you roll everything else over to the transition to retirement pension and draw 10% of it. That would be a way of accessing some super money, or 10% of your super money at least. Follow up with another question if I haven't quite addressed your question there, Kathy. David asks, but the TTR pension is taxable, isn't it? Say if the pension was 50K. There's often a bit of confusion about what's taxable and what's not. The earnings within the fund are taxable in a transition to retirement pension. So that's that equation I showed you before, where if the balance of the fund is $500,000 and it was earning $25,000 within the fund, a transition to retirement pension would still pay 15% tax on earnings, whereas an account-based pension, if you're satisfied a condition of release, or then you pay no tax and save that $3,750. So that will still apply. The 15% tax still applies on a transition to retirement pension. But what we're saying is if you're over 60 years of age, the money that you draw from it, so say, for example, you're drawing 10% of your 50 grand, the money that you draw from it is a tax. It's not taxable. It doesn't add to your taxable income if you're over 60 years of age. So just key to differentiate what you're drawing if you're over 60 being tax-free versus the earnings within the fund still being taxed at 15%. Hope that answers your question there, David. My question was related to your TTR example. Don't need to answer this. Thanks. Oh, sorry. Just answered the question. Yeah, so feel free to keep coming through with questions. As I mentioned, the slides and the recording will be available later, but more than happy to continue to answer questions, even if they're not specifically related to this transition to retirement strategy. Actually, I've got some other Q&A bit over here that I sometimes forget to look at. So I've got William asking, I started a TTR plan at the start of 2016-17 financial year. I don't remember having had to fill out an intent to claim a deduction form to the super fund. Have I missed out for the last 2 years? No. So the intent to claim a deduction form is just a way of making a personal deductible contribution. It's not, if you can effectively implement a transition to retirement strategy or even just a salary sacrifice strategy by salary sacrificing, setting up the arrangement to direct your income directly from your employer into your super. That's the same as a personal deductible, or has the same outcome as a personal deductible contribution. You don't need to have filled out that intent to claim a deduction form for that. Hopefully that makes that clear. Bron says, how can you determine if you can afford to retire possibly a few years early? Yeah, I'm not sure if you attended the first webinar, which was more, it addressed that in more detail. And so go to that website, cornerstonewealth.com.au/retire 2019. The previous webinars there, it talks about when you can retire, how much you need to retire. We can run numbers for you, but it just takes us time and effort, so we charge for it. And it's what we do in the initial consultation. So if you wanted to, we can do it in the initial consultation. But probably a first starting point would be the super equip within your member login within Christian Super. I think their calculator, Nathan, the Chief Member Officer, was saying that it does include the age pension now. It didn't used to, so it wasn't as helpful, but I think the retirement planning calculator within your member login does include your age pension. So is helpful, and it gives you an idea of can you afford to retire early. And then Philip's asking, hi, could you go over the conditions to meet, conditions of release again? Yeah, certainly. I'm 60 in August this year, working part-time and part-time 20K per annum. So, condition of it. So I'm 60 in August this year, working part-time 20K per annum. Yeah, let me go back to that slide for you, which is probably the easiest way. Where was it? How can you access your super? These are the conditions of release. So if you're working part-time and you haven't satisfied a so if you've been working part-time, there's nothing there that you've said that suggests that you've satisfied a condition of release, Philip. So for you to do that, let's say you wait until August, you would have to cease a form of employment. So that would mean either get another job and work effectively 2 jobs, and like you're working full-time but 2 jobs, and then cease that job or cease one of those jobs. That would potentially satisfy a condition of release. You need to cease that job after turning 60. So that could potentially be a condition of release, or you would need to turn 65, and that's a catch-all condition of release. Hopefully that answers your question there, Philip. Tony asks, my wife does not have a super account. Can she access my account should I pass before her? Yeah, good question. Your superannuation sits outside of your will. So it is important to specify to your superannuation trustee, and most of you are from a Christian Super, so get a form from Christian Super called a binding death nomination form. see if I can just quickly grab that form for you. But there are three ways that you can direct your superannuation. Or three ways you can deal with your estate planning with your superannuation. One is that you've got no nomination in place at all. And what we're calling this is a binding or a nomination in terms of where you want your money to go, your superannuation money to go in the event of your death. You've got one option is you've got no nomination at all, so there's nothing specified on your account. Then superannuation, your trustee, Christian Super in most of your cases, would then need to decide where to send your money. And if you've got a spouse, then it's most likely going to go to your spouse. But there could be other people that try to claim that money, whether it's children or previous spouses, etc. So that's if you've got no nomination in place. The next one is a preferred nomination, and in that case, the trustee takes that preferred nomination into account, but they've still got the ability to direct it somewhere else. And I think you can just set up a preferred nomination online, whereas a binding nomination, you need to sign it and have two witnesses signing that, and that will bind the trustee to actually direct it the way you want it to go. So we generally recommend that people have on superannuation accumulation accounts have a binding nomination to their spouse, 100%. And often the reason for that is that you need to support the spouse. But secondly, if it goes to a financial dependent and a spouse is a financial dependent, it goes to them tax-free. You could tap into that next webinar and learn a little bit more about that, but I would encourage you to set up a binding death nomination so that you're directing the money to your spouse in the event of your death. Then also, if there's any insurances in your account, so you might have a $100,000 death benefit that would add $100,000 to your super balance, it would also ensure that that money is going to your spouse as well, and she or he would benefit from it. I hope that answers your question, Tony. Thanks for the question. Just going back to, thanks, David, I think it was saying my screen's back. I'm not sure why the Christian Super site's not coming up, but I can't get it to go. But on the Christian Super site, yeah, thanks for telling me that my screen's blank. On the Christian Super site, if I can get there eventually, I'm not sure why it's not going there. Oh, here we go. On the Christian Super site, I was going to show you where you can find the binding death nomination form, but it's just under forms, and you can download the form yourself, have it, fill it out, and then have it two witnesses and forward it off to Christian Super, and you'll set that binding death nomination up. But thanks, yeah. I did go to the Grand Prix. I'm not a massive Formula One fan, but I've got a 13-year-old and a 14-year-old that absolutely love it. So I was dragged along to the Grand Prix yesterday in Melbourne. Yeah, and this Christian Super site's still not coming up, so I'm not sure what's happening there, whether the site's down or whether it's my internet. So I'm just going to try to catch up on those questions. On the wrong side. So I've got David. I've got your question. I've got David. Oh, yep. Thanks. Great. And ANZ, yeah, thanks for that, David. And then Kathy, so when I turn 65, when I turn 65 but am still working, I can access my super, is that correct? Yes, 65 is a catch-all condition of release. So at that point in time, you can access your superannuation money, you can move it to pension phase, and the earnings on it will be tax-free. So yeah, it's a lot, everything frees up then. The thing that sort of pulls back a bit is your contribution limit. So when you're under 65 years of age, you can bring forward 2 years of annual non-concessional contribution limit. So when you're under 65, you can put up to $300,000 into super. When you're over 65, you've only got the annual $100,000 limit, and you need to satisfy the work test, working 40 hours in 30 days to get the money into super. But yeah, you're right. Kathy, when you're 65, it's fully accessible to you. David says, also bank with Bendigo Bank, play Minecraft, Lego, Lego the Jungle. Yeah, I'm not sure. Some of those things are probably from my kids from using the computer. But yeah. Yes, I'm revealing all about myself by showing you the shortcuts to websites, but thanks, David. We've finally got the website to come up, and I just need to find where the forms are. Oh, there you go. So under members and then forms. So if you go there, and there's I guess all the forms are here. There's the intent to claim notice for intent to claim deduction form. It's just an ATO form that they're linking to, but that's the one that you use if you're making personal deductible contributions rather than salary sacrifice contributions. And here's the binding death nomination form. So if you click on this, it's basically saying, these are my personal details, and I want to specify, for example, my spouse, 100% to my of the benefit to my spouse, and then you sign it, and you need to have 2 witnesses, and the witness can't be a beneficiary, so it needs to be somebody independent to sign that. So that's the binding death nomination, and I think I've covered all the questions off. Now we've gone back to Philip saying, oh, thanks, Sam. Just to clarify, to satisfy condition of release after 60, do I just need to cease one part-time job? I have 2, or do I need to cease both? No, it's just ceasing one of them. So it's ceasing a form of gainful employment. So yeah, you could just cease one of them. Yeah. That's good, and I think we're nearly getting to the end of the question. So if I've missed your question, then maybe put it again in the chat in case I've scrolled down too far without addressing it. But otherwise, I might close off the session quite soon. So there'll be a recording available again on that cornerstonewealth.com.au/retire2019 site. You can register for the new webinars there, or the upcoming webinars there. And Kim's fine. Yep, you've got a question in just before I closed off, so well done. Kim asks, my husband is 69 and still working full time. Next year we will move to part-time, then retire. We both only have just over 100,000 in each of our accounts and have a small amount of 50K owing on our home. Would it be wise to draw down that amount from my husband's account to cancel out debts? Yeah, we often tend to do that. It's a little bit more conservative because theoretically you could say that I've got my money in my super and it's likely, might be in a balanced fund and it's likely to earn 5%, it might earn 8%. And that's double the interest rate that you might be paying. So you might, in some years, do better by retaining the debt and getting a higher return on your super fund money. But you don't know that, whereas you don't know what the return on the super money is going to be. It could be negative in one particular year. So we generally take the more conservative approach to pay off the mortgage and then use that money that was being paid towards the mortgage to implement tax saving strategies, whether that's government co-contribution, spouse contribution, salary sacrifice, or deductible contributions. We try to then use that money to then boost the super back up again. Key thing there is that if your total earnings are less than $80,000, you might be eligible for a part pension. So just factor that in as well, a part age pension. If you're not sure about that, then tap into the, not the next webinar, the one after that, where we go into detail about the age pension. And also consider, particularly for your husband's account, if you're still under 65 years of age, your husband's 69, he could have his money in the pension phase and be having no tax payable on his $100,000 in super. So think about that too. Philip says, thanks for the great info and the team. Yeah, pleasure. And yeah, thanks to Christian Super as well. Tony says, thanks very much and blessings. A pleasure, Tony. Thanks to everyone for being online. Last call for any final question. If anyone's busily typing it in, I'll give you a couple of seconds and before we close off within the hour. Just thanks from Kathy, thank you. And David, thanks very much. Yeah, pleasure. All right. Well, yeah, thanks again for everyone being online. Let us know if you've got questions, or feel free to tap into the next webinar on the 1st of April. And obviously, got open slather at the end to just ask any question you like. So feel free to tap in then. Thanks again. God bless and good night.